Trading psychology is the number one factor that causes most traders to fail. Not the trading platform, not lack of preparation, not the improper trading strategy, but trading psychology itself. In this video, we're going to break down exactly how human psychology affects us as traders, and I'm going to be giving you plenty of tips to avoid these trading psychology issues so that you can start trading more like a robot and seeing more consistent gains in your trading. To understand the importance of trading psychology and how emotions affect us as traders, let's take a look at this study that was done by Norman Wells, who is a psychologist that wrote a book on trading psychology. Norman did a study with 120 traders. Each of them were given a system that has proved to be a valuable and profitable system in 19 out of the past 20 years. These 120 traders tested this system out over the span of a year, and after the end of the year, 119 out of the 120 failed with the system that had proven to be profitable. Only one of them was successful, and statistically speaking, that is simply because of the mindset and the mental tendencies of these traders and not the system itself. So that itself is proof that we can have a profitable trading strategy, and in fact, there are many different trading strategies that can be very profitable for any given trader. What it's going to come down to is if the trader is properly executing the strategy or if they're letting their emotions get in the way. So we've all heard the quote, "It's not about how many times you get knocked down, it's about how many times you stand back up." In the stock market, you're going to get knocked down, you're going to take losses, that is 100% inevitable. Even the best of the best traders take losses from time to time, and it's not necessarily about how many losses you take, it's about how you handle those losses, how you learn from them, and how you move on as a trader. Using technical analysis to manage your risk and to cut losses, to keep your losses small, is going to allow you to live to trade another day, and in other words, it's going to allow you to get back up after you've been knocked down. So it's important to realize and to understand that these losses are necessary and to avoid letting these losses affect the way that you execute your trading strategy. It's pretty common for a new trader to think they found a new strategy that works well for them. They trade it over the span of a couple of weeks or even a couple of months, and they see some success doing that. However, if you fast forward a few weeks or a few months, they end up taking a big loss on one of the trades using the strategy, and suddenly they think that that strategy no longer works. From there, they start to try to find a new strategy that's going to work better, or they become hesitant and start second-guessing themselves when using this strategy, and all of these things are going to affect the way that that strategy performs then in the future. At the end of the day, taking a loss is very normal for any strategy, so you can't let any of these losses get in your head too much and affect the way that you execute your trades. One very common way that a big loss is going to affect an inexperienced trader is by causing them to do what is known as revenge trading. Revenge trading is essentially just the idea of making back a loss that they previously took. So for example, if a trader takes a $1,000 loss on a trade, let's say maybe their maximum risk on that trade they thought was going to be $200, but they weren't disciplined and they didn't cut losses when they were supposed to, so they ended up taking a large loss of $1,000. For that trader, because that is a big loss, that $1,000 is going to be stuck in their head. So then over the next couple of trades, they're going to have in their mind, I need to make back $1,000 on this trade in order to recoup my losses from the previous trade. That is exactly what revenge trading is, and that is a very bad way to trade. Simply put, revenge trading causes a trader to execute bad habits in order to hopefully recoup their previous loss. My advice to avoid this is to simply take a few days off of trading after taking a big loss in order to help clear your head. And then when you come back to trading, start off with smaller position sizes. Now you may be thinking with these smaller position sizes, you're not going to be able to make up your previous loss, but again, that's not the goal when you're first getting back to trading after taking a big loss. The goal is to simply slowly rebuild your confidence in your trading and in your strategy, and that's exactly what you'll be able to do with these smaller position sizes until you're more comfortable again with your trading and you can start to scale back up to larger positions. Now, another huge psychological aspect of trading that every single trader faces from time to time is FOMO. FOMO is the fear of missing out on a trade and the fear of missing out on profits. When we have this fear because of maybe something that we see on social media, maybe we're in a trading group and we see other traders talking about how much money they're making on a certain trade, Or maybe you're watching a scanner and you see a bunch of different stocks that are popping up 10, 20, 30, 50% or more, but you're not making any money on those stocks. All of those things can cause FOMO, and all of those things can cause you to make bad trades and bad decisions. Psychologically speaking, our brains process FOMO as a threat. And once we have that threat in our head, we subconsciously start to panic, and the goal of our brain is then to remove that threat, which can really only be done by executing a trade. To help you prevent yourself from trading based on FOMO, I advise using some different characteristics of the ideal chart setup for your strategy and only taking a trade if the chart meets those characteristics and meets those pieces of criteria. For example, if you are trading momentum, some of the criteria that you might want to look for would be an uptrend, the stock making higher highs and higher lows. You might also want to see that it is trading above the VWAP for the day, and it would also be beneficial if the price is above any levels of key resistance on the daily chart. If you start to feel FOMO and you start to feel the need to get into a trade immediately, analyze the chart first, and if it meets all three of those pieces of criteria for your trading strategy, then I would say it's okay to take the trade. However, if it doesn't, understand that you're probably only feeling this desire to trade that stock because of FOMO, and it's probably going to be best for you to avoid it. This is going to allow you to take a bit of a quality over quantity approach to your trading, and it should help you to increase your accuracy overall. Now let's say that you do end up taking a trade. Once you're actually into a position, this is going to bring in a ton of different emotions that you didn't feel until you actually were in a position. One of those is going to be greed. Greed in the stock market is very common because if you think about it, we're all in the stock market for the same reason. We want to make as much money as we possibly can. So it's a very fine line between letting our winners run and making the most on any given trade and allowing our greed to take over on a trade. Before you even get into a trade, you should be thinking to yourself how much you stand to lose on that trade as opposed to how much you can potentially make. If your entire thought process getting into a trade is, I'm going to make X amount of dollars on this trade, you're probably getting into it for the wrong reason, and you're probably letting greed take over a little bit in your trading. On the other hand, once you're actually in that trade, there is obviously nothing wrong with letting your winners run and making the most out of every single trade, but there is a difference between that and being greedy. If you're in a trade and everything in the price action, all of your technical analysis is telling you that now is the time to get out of the trade, however, you're still holding on to that trade in hopes that you can make more, that is exactly what greed is. This happens often because traders will get into a trade thinking that maybe their goal is to make 15% on the trade. They may be trading a momentum stock and the price has gone in their favor so far. At this point, they're up 10% on the trade, but we see that the price is starting to show signs of momentum slowing. Maybe the stock is making a lower high, or maybe it's starting to crack down below the VWAP. Pretty much everything is telling this trader that now is the time to lock in their 10% in profit and get out of the trade. But because their greed takes over and they know they have that 15% goal in mind, they continue to hold on and they end up watching their winning trade turn into a losing trade. So one tip that I highly advise you to try out if you're someone that experiences greed often in your trading is to avoid looking at your unrealized profit and loss. Your unrealized profit and loss is going to show you exactly how much you're up or how much you're down on a trade at any given time. Psychologically, this can have a big effect on our trading because if you're watching this in real time and you see that maybe at one point in the trade you were at a $500 profit, but now the stock has pulled back and you're only at a $250 profit, even if the price action is telling you that now is the time to sell and lock in your $250 in profit, it's very easy for you to think that you were just up $500 a little bit ago, which might cause you to continue holding even though it is time to sell out of the trade. By hiding your unrealized profit and loss and by not looking at it while you're in a trade, that's going to completely get rid of this trading psychology issue. Now, because we know that losses are 100% inevitable for any type of trading, I'm a firm believer in having a maximum daily loss for your trading account. Now, this can be based off of your trading account balance. Maybe the maximum you're comfortable losing on any given day is 2% of your account balance. That's a good way to go about placing a maximum daily loss. I do understand though that if you are using a smaller trading account, it can be a little bit difficult to place a maximum daily loss relative to your account balance, but in my opinion, it is still important to have one and to stick to it because if you hit that maximum daily loss, That's going to be a sign that maybe you're just not on your A game for the day, or maybe the market is not giving you any A+ setups, and you probably shouldn't be trading in the first place. So hitting that maximum daily loss and ending your trading for the day is a good way to keep yourself from having a trading day that's going to set you back for weeks or even months at a time. This is something that a lot of new traders don't understand, because until you've had that experience yourself where one single loss wipes out days, weeks, or even months of consistent small profits, there's really no way to understand how it feels. And this is something that you can't really experience as a paper trader, because if you're practicing trading using paper trading, you don't really have any real money involved. So even though you do want to succeed with your paper trading to prove to yourself that you can succeed as a real trader, it's still not going to be exactly the same, because you're still not risking any of your hard-earned money. That's why, even though I do believe paper trading can be a great way to figure out which strategies are going to work best for you, I think a better way to go about actually practicing your trading is to start practicing with real money. Now, obviously, if you're a new trader and you're still not very confident in your trading, you are going to want to use as little money as possible. But even if it's just $50, that's still $50 in real money that you're not going to want to lose. And because of that, you can start to get a feel for how psychology and how emotions play into our trading. Because even though these are pretty simple concepts, getting your emotions under control and trading like a robot is something that takes years of experience and years of practice. Make sure to use the tips that we talked about in this video to help you speed up that learning curve. And if you enjoyed this video, please make sure to give it a like and subscribe to the channel so you don't miss out on future uploads. Also, if you want to learn more about day trading, swing trading, and long-term investing, and join us in our daily trading group, you can get started at my website, Master the Market, which will be linked down below. But anyway, thank you for watching. I hope you enjoyed, and good luck with your trading.